Good afternoon, everybody, and welcome to the January 2024 market update with Mike Ott. I'm Cindy Bishop with Cindy Bishop Worldwide, and glad and happy and thrilled that we are starting off January with a little bit of a bang. We've seen some increases in loans, or at least pre-qualifications and stuff. So that's good. We'll get more details from Mike, of course. So our distinguished speaker, Mike Ott, brings a wealth of experience to the table with a background as a former public school teacher and an impressive 19 plus year tenure in the mortgage industry. Mike has earned a stellar reputation. His unique educational approach and unwavering commitment to excellence have endeared him to both clients and agents alike. Mike's profound understanding of the intricate nuances of the market, coupled with his unparalleled attention to detail, make this market update an indispensable resource for you guys seeking to stay ahead, especially of the curve, and being able to understand what's going on in the business. As a senior home loan consultant at First Heritage Mortgage, Mike is well versed in the intricacies of the industries. Additionally, his status as a highly regarded and sought after trainer with us further underscores his expertise, because anybody that knows me well knows that I'm ridiculously particular. So let's extend a warm welcome to Mike. And also we've got this week on the 18th, Mike's doing the FHA 203K. And Mike, I hope that you'll talk about that a little bit so they know how important that is for their business. Take it away.
All right, thanks, Cindy. Happy New Year, everybody. Goodbye and good riddance to 2023. Hopefully we'll have a much better real estate and mortgage year in 2024. And Cindy, as you mentioned, I'm seeing definitely an uptick in pre-approvals, and it's good to kind of see this early activity, already this year, which is kind of nice. It's a good sign. We still need inventory. We still need listings. We'll talk about that a little bit, but let's dive in. Let's jump into rates. Rates have been flat, and that's probably a good thing. I'll show you the chart here on the next slide for mortgage-backed securities. We're kind of in a holding pattern, but again, I see that as a good thing. It's not they're not going down too quickly, and they're not going up, and there's really no forecasting that things are going to get worse or that we see rates to jump up, at least from a technical aspect. When we look at our different programs, conventional conforming 6 3/8 to 6 7/8 is kind of that half-point range that we're seeing the conventional products under that conforming limit fluctuate. When you move to the high balance and jumbo, where we slide up a little bit in that range from 6 3/4 to 7 1/4. Government products, VA loans, 6 to 6 3/4 has kind of been a pretty decent range since about the middle of December. Same for FHA and USDA, 6 1/4 to 6 3/4. I always plug mortgagenewsdaily.com. That's open to all website. You don't need a login. They do a really good job of tracking the national averages across the loan products. So that's always a good resource if you're ever curious where things are standing from a day-to-day perspective, where you don't necessarily need to subscribe or pay for any type of service to see where the rates are and what mortgage-backed securities are doing. Mortgage News Daily is a pretty good resource, and they lag maybe in real time, half hour to 45 minutes, maybe in their reporting. So it's as close to live as you can get for a free service. So it's always a good site to check out. Here's the chart. Snipped this morning, and then I put there my two bold horizontal lines. As you can see, and that jump was really the Fed meeting in December that kind of gave us the boost for once. Chairman Powell came out and actually mentioned and alluded to it, along with the dot plot that comes out, where the voting members of the Fed puts their opinions of where they see rates going. And it was evident from that dot plot chart that a majority of these voting members do see rates coming down in the next 2 years, which was a welcome sign. Bonds loved it. Mortgage-backed securities being in bonds, obviously, we're seeing a good uptick. And it's nice when you take the whole picture in here, you see that climb upward. And remember, mortgage-backed securities, the movement in this chart is inverse to rates. So when this chart, these candlesticks gravitate upwards, that means the rates to the consumers are going down. So up on these charts is a good thing. We've had a really good run, as you can see, kind of since we've had some improvement really going back to October. But now we're in a channel. And I think it's a safe and good place to be. What will cause the next breakout? Who knows? It really hasn't been any of our most recent monthly data that we'll take a look at. And again, these numbers are kind of looking back at November, December in terms of inflation. But we're kind of in this comfortable holding pattern. I did see, of course, as soon as I put this together this morning at around 12:30, I do think there was some negative moves in mortgage-backed securities. We lenders got a lock alert from our systems. But again, I think that was due to, if I read the comments, one of the Fed members was out speaking publicly today and had a rather hawkish tone. And they like to kind of talk tough. And the talk from them has been tough even since the last meeting, where the tone of the meeting was rather dovish. But I think they're just trying to, I don't know, play hardball a little bit, if you will. I don't think they want to see the market run away and get too excited too soon. The bets are that, investors, mortgage analysts are expecting that we might see our first federal funds rate cut at the March meeting. And what you have now is when they're speaking publicly, these voting members, they're all kind of adopting this, don't get your hopes up too high type of mentality. So, when they speak publicly, it influences what the investors do with their money. And obviously what the one person said today, the market didn't like the sound of that too much, but I still think we're going to be oscillating within this range. There's a lot of good technical support underneath here. You see some of those lines and some of those daily moving averages. We've got some pretty good protection, and we're kind of like protected right now by 2 layers of support there. There's a Fibonacci level, and I'm not going to go into what Fibonacci is, but then you see that S1 support line there. And I think the rate lock alert that we just got was probably because the mortgage-backed securities dipped below those 2 support structures there, but I doubt they're anywhere near that second level of support down there. So I don't think it's anything to be concerned about. So why are we in this channel? Well, we had, since last update, we had the December PCE report, which reports inflation data from November. Headline number there was down to 2.6 from 3%. Now that's a good move, right? Because Fed loves to see a 2 in front of these numbers, because their whole mandated goal is to keep inflation at or around 2% over, on average. So that's a good headline number. Core PC, remember they strip out food and energy for that. It was down 0.3 from 3.5 to 3.2. We're looking, the hope here, and I think what we'll see is, I think our next best chance for mortgage rate improvement is if the future data gets us to where we're out of the 3s in terms of that percentage, and we get a 2 in front of that. A 2.9 would be, and I think it's one of those things where it's a matter of time. There's huge lags in this data reporting, and we always look at kind of an annualized over the last 6 months. That core inflation rate fell from 2.4 to 1.85. That's below the Fed's target. So with lags in consideration, I think we're going to get there. And this is a big number and a big reason why you have investors and economists thinking that we're likely to see the Fed lower at that March meeting. And if not in March, then all the bets will be on the May meeting. So we just have to wait and see. Jobs data that came out since the last meeting, December ADP employment report came up, showed jobs a little bit hotter than expected at 164,000 when 130 was expected. The BLS jobs report came out on January 5th. It reported 216,000 jobs versus 170,000 expected. So while these numbers look hot, there's definitely some potential for errors in the data collection and the modeling that they use to arrive at these numbers. And the one that's got the biggest problem in regards to that is this BLS jobs report. Because when you take a look back, we've had, previous months being revised down. We've had 500,000 job revisions, meaning they're deducting 500,000 jobs. And that's from last year. So that's like 40. They're basically saying that this number that we get on these days of the reporting, there's about a 40,000 job correction there that we're not seeing. And the problem is when these numbers come in and out and then come out hot, all your traders and investors, they're trading on the reported numbers. They don't report on the revisions that have gone lower and lower each month. So that's something to keep an eye on. Part of that jobs report's the unemployment rate. It remained at 3.7. It missed the expectations. The expectation that we were going to see a little bit of an increase to 3.8. It didn't happen. But again, you have to kind of look, some of this data is very misleading. Multiple job holders increased 222,000 full-time jobs, right? We lost 1.5 million full-time jobs. And then as you can see there, the part-time jobs increased 762. And again, I've talked about this before. What this is a sign of is that you've got people under, financial pressure that they're going out and they're getting a second, sometimes a third job to make ends meet. And that's not good for the economy when you lift up the hood and take a look underneath, right? We're losing the full-time jobs. So out of those three categories, who's buying homes? Your full-time job people, right? And we're losing them. So again, I think we're still going to see some unemployment increase, provided these data trends hold. Average hourly earnings was up, and again, that was better than expectations. Why does it matter? Well, if people are making more money, then there's more money to spend, and that's inflationary. Now, the reality is that part of that report, and I didn't squeeze it in here, but on the back end, when you dig deeper, hours worked, and this has been the case for months now. The hours worked, the average hours worked is decreasing. So pay might be going up, but hours worked is decreasing. And another reason why this report in December probably showed, an uptick in some of these numbers was it was the first report to include the United Auto Work strikers going back in and now getting their pay increases. So from that perspective, that little bump or that little boost makes these numbers probably look a lot better than they really are in reality. Now, CPI for December, this just came out. The reason why we're having this market update this week is because I wanted to wait and get the data from last Thursday, and our headline inflation number was up 0.3%, which was higher than the 0.2% that was expected. But core CPI was up 0.3%. That was higher than the 0.2%. But the year-over-year decline, and this is again what the Fed's looking at, this core stripping out food and energy, we actually went down a tick from 4 to 3.9. Shelter costs are still lagging, but showing signs of cooling. And the big thing to remember is that the shelter costs, and this is rent, rent away from home, lodging away from home, this is your Airbnbs, your hotels. This makes up 44% of CPI, so it's a pretty big chunk. And the fact that it's got such a lag to it, and these numbers have been coming down, and the real-time numbers are much lower, but the way they're averaged over time, is what's taking it so long to kind of to catch up. So we remain a little bit elevated, but nothing out of the ordinary or nothing that would change the vision that inflation is cooling. Things are coming into you know, kind of what we're expecting with the cooling of inflation, the Fed's hand being forced into lowering the federal funds rate, and therefore mortgage rates obviously benefiting from that as well. Now, our next Fed meeting, January 30 and 31. Again, no expected moves in terms of rates. It'll be more of just hey, what data do we get? We'll have another PCE before that meeting at the end of the month. I do not know if we'll have ABP and BLS before that meeting. If not, it's got to be right around the same time. So it'll be interesting to what the comments will be when it gets to the question and answer session on the 31st, and what Chair Powell's what his comments are like. Will he be as dovish as he was at the last meeting, or will he start talking tough again? So remains to be seen. Any question on all that nerdy market stuff? But at least gives you, like I said, this is the stuff that's behind all this. You know, not to get too technical, but I think it's important that we understand kind of what drives, you know, the day-to-day fluctuations and where things might be headed. It's buried in all this data for sure. All right. Local real estate, NVAR. So this is looking back now at December, kind of year-end numbers. Median price was 675. That was up year over year, 12.5%. Now total sales, obviously, we know and we feel this, they were down year over year, 16.3%. Prince William medium sales price was 528, right on the dot. That's up 17.3 year over year. Total sales volume down 7.5. The Dulles area median sales price 717 per 100. That's up 12.5 year over year. Total sales down 5.2% year over year. Now, what's the talking points? When you've got all those people that don't want to list because they're afraid about buying and having a higher rate, or you've got your first-time buyer prospects that are like, I'm going to sit back and wait till rates drop. Show them these numbers, right? That your price isn't going down. The shortage in inventory prices are up, and they're going to continue to go up. Now, are they going to go up ridiculously like they have, you know, let's say during the, you know, COVID 2021 and 2022? Probably not, but a modest, let's say 4.5, anywhere really between 4 and 6% for this region is going to be pretty normal, but definitely values going up. So, you know, the sideline sitters, while they might be waiting for rates, they're going to pay more for the house later by doing so. Lending information. I left this some of this information up since our last meeting. Obviously, with the first of the year, we have our 2024 conforming loan limits. The new limit is 766,550, up from 726,200. High cost areas, which is our DC metropolitan area. We have a high balance of 1,149,825. That's up from 1,089,300. That means the jumbo loans, the floor loan amount goes from $1 over to conforming loan. All agencies obviously have adapted that, so that's not just conventional, that's FHA, VA, USDA as well. Virginia Housing, I left this on from last time because it went into effect in December. They did increase their household income limits. And remember, they break the household up into 2 or fewer or 3 or more. They increased the max price in that Northern Virginia region to $725. Now, I added this because what they did sneak in there, and we were waiting for more clarification on, who could utilize this, what were the ins and outs of it. They have a non-bond program. They're calling it their expanded program. And what they've done here is they are allowing now not only first-time buyers, but subsequent buyers as well, or seasoned owners and buyers, to utilize this program. And I just pointed out that the DC area qualifying, and I want to emphasize qualifying income on this. We're so used to Virginia Housing when you get the grant and the down payment assistance that we know that there's these household income limits, and it's like, hey, who is 18 years old and in the house and earning income, and if they exist, that has to be reported, regardless of who's on the loan. And that's really in particular with the grant program. This non-bond program has a much elevated income, qualifying income limit of 228,000. I mean, that's super, super good for the Northern Virginia region. And they can still use the plus second mortgage for 100% financing and not necessarily have to be a first-time buyer. And just like the regular plus program on the bond and grant programs, the second mortgage interest rate will be the same as it is on the first. Now, I'll be upfront with you, completely transparent, that the rates on this non-bond program are probably going to be anywhere between 0.25% higher than the bond programs. But nonetheless, this opens up a new category to some buyers that, let's say, they make too much money to fit into the box to be able to do the grant. But it still gives them an opportunity to still get the assistance with the plus second mortgage, which is, it could be a pretty big deal. This non-bond program actually goes up to the agency conforming limit, so that the maximum limit is going to be the 766,550 on this. And that's great because, again, if you look over there, the bond and the regular programs with the assistance, they're going to be capped at 725,000. So we're excited in Virginia to have this program. And I left on here, there's still other great low down options. There's a 1% down, no PMI, conventional loan product. The only thing that makes it a little bit tough in the Northern Virginia region outside of DC, it's a maximum loan amount of 350. For those of you that are a little bit further out from the bullseye of DC, and you're more comfortably in that 350,000 price range or below, this could be a really good product for your buyers that fit into the conventional. And again, obviously with conventional, there is you get the 2% grant, but they do have the borrower qualifying income has to be at 80% or less of the area median income for that area. Right. So borrowers basically have to come up with 1% of their own money, and that can be gift. It could be 401k loan. Right. So there's definitely some flexibility there. Any questions on the lending stuff? Virginia Housing, loan limits? All right, and I had this on last month too, but I think it's worth keeping on as we enter, 2024. I borrowed this infographic from the Buffini and Company because I sat through one of their presentations. It was talking about the top 10 reasons people are moving in 2024. And a lot of talk about, is this environment that we're in right now the sweet spot where early adopters will see an opportunity? you know, and I put down there questions to pose potential sellers, like, do you want to wait and list until rates bottom out? Which again is good if you're a seller, right? But if you're a seller who has to buy somewhere else, well, then you're getting to rock bottom rates. Guess what's going to happen? All the buyers are going to come back in the market, and there is a tsunami of them waiting. We've got a lot of people with that mentality. Our job, in my opinion, is to get them, you know, flip that script a little bit and get them to see that now might be the best opportunity, right? Because if you're an early adopter, list the house now while rates are coming down, sell the home at a fair price, then buy the home you wanted over the past few years at a fair price without being out there with all these other buyers in a bidding war, and get a fair interest rate in the process. And that's where we, you know, talked about the marry the house, date the rate. You know, you can do this move now. You can sell and buy in this environment. Yeah, you might be forfeiting your 3%, 4% interest rate on your current loan. But let's say if you buy where we are in the sixes now, you know, these buyers have to keep in mind that they'll have an opportunity to refinance in the future. And when it's time to refinance, there's no competition, right? That's important for us to point out to them, that if you can get in, tolerate payment, and be comfortable, that it's probably worth doing now rather than waiting for rates to bottom out. Because again, rates bottom out, that's going to be, and I've said this about rates coming down, if they come down too quickly, we're going to have, you know, 2020, 2021 all over again. And that's, you know, that's going to be tough on the buyer side. And I know some of us in Northern Virginia, we're still seeing it because, and the reason why we're seeing bid over ask, waiving contingencies, things of that nature is because we have such low levels of inventory. We still have, even despite rates being higher, we've consistently had more buyers than there are available houses. And that's a wrap from my end. You guys have any questions, comments? What are you seeing? What do you feel? What are you sensing so far about the start of 2024? I'm busier in the last 3 weeks than I felt like I was the entire fourth quarter. So I don't know if any of you experienced that as well.
Well, that's a good sign.
I agree.
It's
I
great.
agree as well. A lot more interest.
Yes.
Yeah. Yeah, I feel like, and you know, when I look, I was taking a look at a lot of my recent applications have all been, well, not all, but most of them are from what I refer to as seeds planted months, if not a year ago. And now it seems like, I don't know, you've got maybe it was a lot of people's New Year's resolution to buy a house or to you know, to do a move up buy. But a lot of the activity I'm seeing right now are from people that I started to have the conversation with, or their past clients, where we started to have this conversation much earlier, right? And I think this, you know, if they're going to be in this sweet spot, early adopters to make this move and to buy real estate, I think they're only going to reap the benefits of it long term. And yeah, don't, as Cindy mentioned earlier, we're doing the FHA 203K renovation loan class on Thursday. Cindy, is this our new, did we move this to 9:30 to 11:30?
Let me double check. It's
I know we talked about moving back a half hour.
I'm gonna have to look. I don't think so. I think I did 9 to 11 because it was already, I'm a couple months out.
It's already public. Okay, 9 to 11.
Yeah.
Yeah. 9 to 11 Thursday morning. We'd love to have you join us. That's a great niche product that, you know, it's really neat to see how that loan can help you. And I always tell the agents too, you know, that's good information to have on the buy side, but then also on the listing side as well, because you might be you might be doing a listing appointment on a house that could use a little TLC, and maybe it's worth marketing the property and getting your sellers' heads around the idea of marketing it, with renovation financing. Could be, like I said, that could be a huge plus on the listing side. It's not just about, hey, I want to know more about this just for when I'm quoting buyers, but, and it's at the end of the day, when you scrape everything away, it's still an FHA 30-year fixed. But if you come to the class, you'll kind of see all the little nuances about it and some of the nitty gritty that you have to kind of keep in mind along the way.
I confirmed at 9 to 11.
9 to 11, all right.
All right, so we all done? Mike?
Yeah, I'm
All set?
good.
Okay, anybody have any
I was
questions?
double checking the chat, see, show, Happy New Year.
Yeah, to everybody. Yeah.
Good to see you, good to see you on here, my friend. Yeah, and yeah, stay safe out there if you're on these snowy roads.
And remember, this recording will be on Mike's instructor page on our cindybishopworldwide.com site, okay? Take care, everybody. Thanks, Mike.
Hi, guys.
Bye-bye.
Thank you.